In December 2001, a titan of American industry filed for what was, at the time, the largest corporate bankruptcy in the nation's history. The sudden collapse wiped out $60 billion in market value. 20,000 employees lost their jobs, and many found their retirement savings completely erased. Yet, as the workforce was left with nothing, the top executives responsible for the crash walked away with hundreds of millions of dollars. Just months earlier, Enron was the seventh largest company in the United States, routinely celebrated by Wall Street as the nation's most innovative business. The numbers on their official reports were flawless. But how did a company this massive, universally praised by analysts and investors, turn out to be a complete financial mirage? The path to that collapse started in the 1980s. Founder Kenneth Lay saw a massive opportunity in the federal deregulation of the energy markets. To execute his vision, Lay hired Jeffrey Skilling, an executive who steered the company away from operating physical pipelines and turned it into an aggressive energy trading firm. Skilling's new strategy required a different way of keeping the books. He pushed regulators for a change, and in 1992, the SEC permitted Enron to adopt a practice known as mark-to-market accounting. Under traditional accounting, a company logs revenue as the cash actually comes in. With mark-to-market, Enron could estimate the total projected profits of a 10-year contract and log that entire amount on their balance sheet the exact day the ink dried. If those long-term projections were wrong or the deals failed, the company recorded no actual cash. To cover the shortfall, executives had to continuously sign new, increasingly risky deals just to maintain the baseline. They became addicted to booking hypothetical future revenue, creating a permanent, widening gap between the profits they reported and the cash they actually held. Eventually, reality caught up. As massive international infrastructure projects began to fail, Enron started bleeding real cash. Chief Financial Officer Andrew Fastow was given a clear mandate: solve the problem of hiding these mounting, very real losses from Wall Street investors. Fastow's solution was a network of offshore shell companies, special purpose entities with names like Chuco, LJM, and the Raptors. Instead of reporting the losses, executives transferred toxic debt and failing assets off the official balance sheet into obscured holding companies. But these structures had a fatal flaw. Fastow guaranteed these off-the-books entities using Enron's inflated stock price as the primary collateral. When the shell companies weren't enough, Fastow turned to major Wall Street banks like JP Morgan and Citigroup to secure hidden loans, known internally as prepays. The banks structured these massive cash infusions as circular commodity trades. This allowed the borrowed money to be recorded, in their own words, as cash flow from operations. By hiding billions in offshore boxes and disguising bank loans as operating income, the finance team mathematically transformed catastrophic losses into record-breaking profits in plain sight. A deception on this scale naturally raises a question: how did an entire corporation of thousands of employees keep this massive scheme a secret? Management ensured that silence through a brutal internal performance review system known as rank and yank. Every 6 months, employees were graded on a strict curve. The bottom 20% were systematically fired, regardless of their absolute performance. Meanwhile, the employees at the top were rewarded with massive bonuses tied directly to the volume of deals they closed, with no regard for the actual cash flow or the ethics of those deals. The promise of immense wealth combined with the constant threat of termination turned the corporate environment into a blood sport, effectively silencing anyone who might question the math. In the early 2000s, the broader tech bubble burst, and Enron's artificially high stock price finally began to slip. Because the hidden debt was collateralized by their own stock, the falling share price triggered a margin call. The supports snapped, and billions in toxic debt were forced straight back onto the main balance sheet. In October 2001, executives panicked the market, announcing a massive third-quarter loss and a billion-dollar write-down. Internally, Vice President Sharon Watkins had already seen the math unraveling. She broke the culture of silence, warning Ken Lay the company was imploding. Shortly after the public write-down, the Securities and Exchange Commission launched an investigation into their accounting practices. Rather than protect the public, Enron's outside auditor, the prestigious accounting firm Andersen, responded to the investigation by mass shredding thousands of financial documents. The heist lasted as long as it did because the gatekeepers designed to catch the fraud, the auditors and the banks, were actively participating in the cover-up. Federal prosecutors eventually secured convictions against Skilling, Lay, and Fastow for their roles in the conspiracy. The collateral damage extended beyond the executives. Arthur Andersen was convicted of obstruction of justice, resulting in the total collapse of an 89-year-old pillar of the accounting industry. In response to the devastation, Congress passed the Sarbanes-Oxley Act, holding corporate executives personally and criminally liable for the accuracy of their financial reporting. Enron did not fail because of a bad product. It collapsed because its leadership prioritized short-term stock valuation over the reality of their business, proving that when a corporate culture demands continuous miracles, the profits are almost always an illusion.